Can you buy a home in New York City with $200,000 per year income? And the short answer is yes, you can. Now the second question would be, how much home can you actually afford with $200,000 per year income in New York City? In this video, we'll take a look at some actual numbers and examples for you to understand the important math behind the scenes, which will help you to determine what kind of price point home you can be qualified to buy based on your actual salary. From there, you can make your own decision whether it makes sense for you to buy now, or maybe it's better to set some goals and achieve that homeowner status in the near future. By the way, just to be clear, the decision to buy isn't based on numbers only if you're looking to buy a primary residence. There are a few other important factors that you also need to consider besides just the financial aspect of the transaction, but that's a topic for another video. Today, we're talking numbers. What is up, everyone? My name is Sargis. In case you're watching this channel for the first time, I'm a licensed real estate agent based here in New York City, and this channel is all about New York City real estate when it comes to buying, selling, and renting. The reason I'm going to use $200,000 per year salary is the headline published by CNBC back in July stating that average rent in Manhattan was a record $5,000 last month. And in February, they published another article saying that Manhattan rents hit an all-time high in January. The average rent in Manhattan was just over $5,000, up 13% over January 2022. In order for you to be able to rent $5,000 per month home in New York City, most landlords across the city use 40x rule to qualify the tenants, which means your annual salary should be 40 times your monthly rent. So to be qualified to rent $5,000 per month home, you should be making around $200,000 per year. Which brings us to the question of today's video. If you don't want to rent, what kind of home can you buy having a $200,000 per year income, and what your monthly payments will look like? Because we're going to look at some actual examples, I will encourage you to get a pen and paper and follow along with me so you can adjust the numbers based on your specific situation. Before we start, as a disclaimer, the numbers and calculations you'll see in this video are just examples and are for informational purposes only. Every transaction is different, everyone's situation is different, and there are many other factors that will have an impact on your decision. So always talk to a professional before considering any transaction. Speaking of talking to a professional, there is a link in the description of this video where you can schedule your one-on-one consultation call with me if you're looking to buy, sell, or rent here in New York City, or if you just have questions about New York City real estate. And don't forget to like the video and subscribe to the channel for more New York City real estate videos like this. Now let's get to the video. Let's start with clarifying one thing, which is it's not that accurate to try to determine your price point just based on your salary, because the affordability of your home mostly depends on your monthly payments. Three main factors that determine your monthly payments are the down payment that you're going to put, which dictates how much money you're going to borrow, the carrying costs of that specific apartment, and your interest rates, because the higher your interest rates, the more it's going to cost you to borrow money, which decreases your purchasing power. Now let's take a closer look at your monthly payments. $200,000 per year translates into $16,666 per month income. For W-2 employees who are on a payroll, your gross income, which is the money before taxes and everything else are taken out from your paycheck, is the number that the lenders will use to qualify you for a mortgage. For business owners, contractors, and freelancers, your qualifying income is not your gross revenue, what you see in your 1099. It takes a little bit more work for your lender to figure out your qualifying income, and you'll need to submit some additional paperwork. Because your income may vary significantly from year to year, they'll need to make sure that your income is consistent and stable to afford the mortgage payments. They'll want to see your last 2 years of tax returns, including your Schedule C, Schedule E, depending on if you have a commission-based income, rental income, royalties, partnerships, S corporations, estates, trusts, and so on. Maybe you can be qualified for an asset depletion mortgage, which basically means if you have substantial assets rather than a traditional income, you can use your assets to qualify for a loan. Just make sure to consult with a loan officer or a mortgage broker to understand your mortgage qualifications. I don't want to complicate today's video, so we are looking at an example for someone who is on a payroll, gets W-2, 32 at the end of the year, has $200,000 per year salary, which qualifies him or her to rent $5,000 per month apartment, but they don't want to rent and prefer to buy. So to understand how much of your paycheck can go towards your housing payments, first we have to determine your acceptable DTI, which stands for debt to income ratio. This is a percentage that shows how much debt you're allowed to have, including your future housing payments, in relation to your monthly income. One of the biggest factors when determining your acceptable DTI is the type of property you're buying. For the market I specialize in, which is New York City market, we are going to separate property types as co-ops and everything else. Everything else can be a condo, townhouse, single family or multifamily detached house. There's also another type of property called condo, which is a mixture of condominium and cooperative ownership structures. Basically, the residential portion is a co-op, but there can be some important differences between an actual co-op and a condo. Since there are not a lot of condos in New York City, we are not going to discuss this property type. But if you come across to an apartment in a condo building, use the link in the description below to book a call with me and we can talk about everything you need to know about condo ownership structure. The reason we're separating co-ops and everything else is because every co-op has its own requirements when it comes to a DTI ratio. And it doesn't matter which lender you're working with, what kind of loan program you can be qualified for, and how much money your lender is willing to give you to buy an apartment. If you don't satisfy that specific co-op building's financial requirements, your purchase application most likely will be rejected. And yes, co-op boards can reject any resale or sublet applications. If you're new to my channel, I already made a lot of videos explaining what a co-op is, requirements, board package, pros and cons, and more. So make sure to watch those videos as well if you're not familiar with the concept of a co-op. Now let's take a look at some actual numbers. For this example, $200,000 per year is $16,666 per month income. Now the safe number for buying a co-op in general is you want to stay under 30% DTI, ideally 28 or 29%, which means all your monthly debt payments plus your future housing payments cannot exceed 29% of your monthly gross income. Now there are co-ops in the city that aren't too strict and will allow higher DTI ratio. I've sold an apartment in a co-op building that allows 40% DTI, and there are also co-ops that would want to see way less than 29% DTI, could be 25, 20, or even less. For this example, since we're just starting the home buying process, we don't know anything yet, we're going to take 28% as an acceptable DTI. But this is why it's very important to work with a pro agent, because depending on the area and the building itself, your acceptable DTI can be more or less. So for this example, if we want to stay under 28% DTI, that will give us a total debt payments of $4,666 per month. From here, we must subtract all your existing debts. Examples of debts are your auto loan, personal loan, any other existing mortgages, basically any installment payments that are collected from you over time and show up in your credit report. For revolving accounts, if you have any credit card balances, the minimum payments of your credit cards also count towards your debts. Other debts that you need to be on the lookout and discuss them for your specific case are your student loans, any installment loans due in less than 10 months, and any judgments against you. Your loan officer will clarify those for lending purposes, and your real estate agent hopefully should be able to clarify this for co-op requirement purposes. Your food expenses, gym membership, Amazon Prime subscription, utilities, and things like that don't count towards your debts. The person in this example, let's say, has $400 per month car payment and one credit card with a balance which has $35 minimum monthly payment. Because credit cards usually have insanely high interest rates, it's not the best idea to finance any big purchase with a credit card. If you really have to make that big purchase, it might make sense to get a 0% introductory APR card or take advantage of some other promotion that your credit card issuer is giving you so you don't have to pay interest. But that's a topic for another video. Now back to this example. So $400 car payment and $35 minimum credit card payment every month. If we subtract your debts from your maximum DTI number, that will give us the maximum housing payments that you should have. So with $200,000 income, if we're doing 28% DTI, your maximum debt needs to be $4,666, which means your maximum housing payment should be $4,231 per month. So that $4,231 per month payment includes your principal, interest, taxes, insurance, which altogether are known as PITI. And in New York City, we add another A at the end, which stands for Association for Condos and Co-ops. Basically your HOA fees. With co-ops, taxes and HOA is bundled into one payment, which is called a monthly maintenance. If you look at any co-op listing, you'll see this payment here. If you look at a condo listing, you'll see that taxes are separate from your HOA, which we call it common charges in New York City. If you want to know what do those payments cover, the differences between condo common charges and co-op maintenance, and why those are the way they are, watch this video. Everything you need to know about condo co-op monthly payments are explained there. So far we subtracted your existing debts from your total debt payment, and for this example we have $4,231 per month to cover your housing payments. That's PITIA. For co-ops, this number is a combination of your mortgage payments, that's P&I, principal and interest. Insurance is the second I, and the monthly maintenance of the apartment you're buying, T and A combined together, taxes and association. Your lender will always include the insurance when calculating your DTI, but for this example, we can remove the insurance. Usually, you're not going to get your actual insurance premium until a few days before the closing, unless for some reason your lender requires you to have it earlier. But when you're in the process of submitting your board package for a co-op, they'll look at your mortgage and maintenance payments, and of course your other existing debts. But talk to your agent and your lender for your specific case. This is where you need to adjust some numbers because the monthly maintenance payments from building to building varies a lot. And it depends on the location of the building, size of the building, what kind of amenities that building offers, and many other factors. Let's say for this example, you need one bedroom apartment and you want to live in Upper East Side between 60th and 96th Streets. You don't need a luxury building, you just want an elevator if the apartment is above 3rd floor. Full-time doorman would be nice to have, but if not, it's not a deal breaker for you. And this is kind of how the thought process goes, because first you need to figure out what type of apartment you need, how many bedrooms, bathrooms, and other features of the apartment. For example, a balcony or in-unit washer dryer and things like that. Then the location, but if you don't know the exact neighborhood where you want to live, usually people know at least the general area where they want to be. If we take an example of Manhattan, which is the area where I primarily work, if buyers don't know the exact neighborhood, usually they at least know if they would like to live in Uptown, Midtown, Downtown, East Side, West Side. If you're moving to New York City and have no idea where to go and how to even decide the location, just reach out to me. The link is in the description below. For this example, we have the type of the apartment and the location. Then we have to determine what are the must-have amenities for you. It can be a full-time doorman, rooftop, gym, pool, common outdoor terrace, laundry in the building, and so on. For this example, you said you must have an elevator if the apartment is above 3rd floor, and full-time doorman would be nice to have, but if not, it's not a deal breaker for you. The maintenance of the apartments that fit your needs in that specific area are roughly around $1,300 to $1,900 per month range. There are actual one-bedroom apartments in that area that have more than $3,000 per month maintenance. And it is also possible to come across to a one-bedroom apartment in that area that has around $1,000 per month maintenance. Let's say we're going to take $1,600 per month as a limit of how much you would like to spend for maintenance, which means your mortgage payments, principal and interest should fit within this budget if the apartment you're looking at has $1,600 per month maintenance. In this example, we have $2,631 for your mortgage payment. Now, the important thing to understand here, if you remember, I mentioned earlier that your mortgage payment depends on the amount you are borrowing and the interest rate. not the purchase price. From here, you can go to any website that has a mortgage calculator tool and try to determine the numbers that work for you. For this example, the interest rates today for 30-year fixed are around 6.25%. People usually tend to take that 30-year fixed as a standard, but this is why it's very important to work with an experienced loan officer, because there are other loan programs that can be better for you than a 30-year fixed. But for the sake of this example, we're taking 6.25%. The down payment amount is the number that will determine how much you need to borrow. The majority of co-ops across the city will require at least 20% down payment, but it's not uncommon to see co-ops, especially in that Upper East Side area, that require 30, 40, or even 50% down payment. I also uncheck this tax and insurance check mark because I like to do principal and interest calculations separately. Let's say you're putting 20% down payment with 30-year fixed term 6.25% interest rate mortgage. If we try to get around $2,631 per month mortgage payment, right about here, the maximum purchase price for your DTI comes out to be $530,000 if the maintenance of the apartment is $1,600 per month. Now, if let's say we find an apartment that has $1,100 monthly maintenance payment, this leaves a room of up to $3,131 per month for your mortgage payments. If we increase the purchase price until you're at your monthly mortgage payment limit, looks like now you can be qualified to purchase a home for $630,000. Again, assuming you put 20% down payment and the building allows 28% DTI. Just one important note that this is not the listing price, okay? We're talking about your actual purchase price. This does not mean that you have to filter and see only apartments that are listed below $630,000. Some apartments can be overpriced, and depending on the market and how well your agent can negotiate on your behalf, you might be able to buy it with less than asking price. There are cases that the home might be underpriced, and you also need to be able to recognize the good deal in front of you and act fast. That's why work with a pro agent, someone who knows how to find, negotiate, and complete the transaction. Let's adjust some numbers here one more time and you'll see how the purchase price changes. If you can put 30% down payment, well, now with the same $630,000 purchase price, your mortgage payments are going to be $2,715 per month. If you remember, your limit was $3,131 per month if the monthly maintenance of the apartment is $1,100, which means with your same DTI limit, now you have an option to be qualified for up to $720,000 purchase price. Of course, assuming you can put 30% of your purchase price for down payment. Also remember, this example is for 28% DTI and assuming that you have a car payment and a credit card balance. So if you don't have a car payment and a credit card balance, going back to our first example, with 20% down payment and for an apartment having $1,600 per month maintenance, now you have more purchasing power and can buy up to $620,000 versus $530,000 we had before with your existing debts. If the acceptable DTI can be higher than 28%, let's say 33%, then your purchasing power changes again. This is basically how the purchase price qualification changes for the same person who has $200,000 per year income. It all depends on the building's acceptable DTI, your other existing debts, the maintenance of that specific apartment, down payment that you're able to put, and the interest rate. I know this is a little bit confusing, especially if you're a first-time home buyer in New York City. This step of determining your budget is very complicated, especially with co-ops, because there are a lot of moving parts. You might be qualified in one building, but with the same purchase price, not qualified in another. And the reason we're taking co-ops acceptable DTI instead of your lenders is because co-ops usually have way more strict requirements. Just to be clear, this was for you to understand how the math works and how much you can be qualified for, not how much you should go ahead and spend. Those are two different things. Also, another important factor I want to mention when determining someone's qualifications for co-ops is what's called a post-closing liquidity. We're not going to get all the details about post-closing liquidity in this video, but in short, this basically means how much liquid assets you have after you complete the purchase. Usually this is measured by how many months worth of mortgage and maintenance payments can your liquid assets cover after you complete the purchase. For the sake of simplicity, if your maintenance is $1,000 and your mortgage payments are $2,000, if after you complete the purchase you have $36,000 in reserves, this means you have 12 months post-closing liquidity. And again, different buildings have different requirements regarding this amount and different requirements when it comes to which type of assets can be counted towards your post-closing reserves, because some assets are less liquid than others. I talk about this more details in my co-op financial requirement video, so feel free to watch that. The link is in the description below. This is basically what the process looks like in real life with my clients who are about to start their home buying journey. We figure out their needs, what type of properties we're going to look at, location, we'll have a clear understanding of their budget and all the requirements that they need to be aware of, including the down payment, DTI, and post-closing reserves. Also, the closing costs, which we didn't even talk about in this video. But the good news is I already have a video ready for you if you want to know what kind of closing costs you need to budget for. The link of this video is in the description below. In other words, we make your home buying journey a fun and enjoyable experience. Now with condos, the difference is that the building does not qualify you and you have more freedom with your DTI. The same is if you're buying a townhouse or a single family or multifamily detached house. Whatever loan program you can be qualified for with however much DTI and post-closing reserves your bank requires, if the seller accepts your offer, then you should be able to complete your purchase. One thing you need to be very careful of, mostly if you're buying any other type of property than a co-op, is the risk of overspending and buying more than you can afford. With co-ops, if the building isn't too strict and doesn't qualify the buyers properly, you can end up buying a co-op with a very high DTI. But with typical co-ops that have strict financial requirements, it's kind of hard to overspend, because if you can't satisfy the building's financial requirements, such as the acceptable DTI, post-closing liquidity, or any other financial requirement, your purchase application will most likely be rejected. With condos, there are loan programs that can go as high as 48 or 49% DTI, which means with our previous numbers, if you make $200,000 per year or $16,666 per month, with 43% DTI, you'll be qualified to have $7,166 per month debt payments. And if we subtract as an example the same car payment and your credit card minimum payment, you'll be qualified to have $6,731 per month PITI payments. Homeowners insurance premium for condos and co-ops can vary depending on multiple factors, but generally when we are just starting the process, we can take $50 or $60 per month as a baseline. For the same type of one bedroom, one bathroom condo in the same area, you're looking at roughly $1,500 to $2,200 per month carrying cost, which is a combination of your common charges and property taxes. Again, there are one bedroom condos in the area that have very expensive carrying costs, and it is also possible to find a condo with cheaper carrying costs. But if, for example, you're allocating $1,900 per month for taxes and common charges, and we subtract $50 for the insurance, if we go back to our mortgage calculator tool with the same interest rate with 20% down payment and being qualified to have $4,781 per month principal and interest payment, your purchase price for a condo can be up to $970,000. Let's say you don't want to have more than 35% DTI. Now, the maximum purchase price for the same down payment, interest rate, and carrying costs is going to be $700,000. For condos, you also have to submit a board package, and generally speaking, condo buildings board package can range from filling out a few personal information forms and signing couple documents to providing all your financial profile. But regardless of how complex or easy the board package is, the difference is that the condo boards can ask for information, but they don't qualify the buyers and they cannot just reject the application. Instead of approving or rejecting, they have a right of first refusal. which basically means they have the right to buy the unit first with the same price and terms as agreed by the buyer and seller. Watch this video if you want to know all the details of a condo board package and what the process looks like if you're buying a condo. But back to today's video, I can't emphasize this enough. Be very careful and responsible with your budget. Just because you're qualified for a certain amount of mortgage by your lender and there is no one to reject your purchase, it doesn't mean that you should go ahead and borrow the maximum amount they're giving you. Being qualified versus what you can afford are two different things. 48-49% DTI is very high. With condos and other types of properties, it's very easy to overspend and have huge monthly housing payments. Recommendations for maximum housing payments are different for everyone, and it depends on your specific situation. If you're having a hard time figuring out your max budget, talk to a licensed professional. Everyone has different long and short-term goals. Always keep your goals in mind when considering any large purchase, especially a home, and have a clear understanding of what kind of impact that purchase will have on your goals. Hope this video was helpful for you to understand the math for real estate in New York City and the thought process when trying to figure out your budget and qualifications. If you got any value, like the video and subscribe to the channel for more New York City real estate videos. Don't forget, there is a link in the description of this video where you can schedule your one-on-one call with me if you're looking to buy, sell, or rent here in New York City, or if you just have questions about New York City real estate. You'll see another video on your screen which apparently YouTube thinks is the best for you to watch next. Thanks for watching. Until next time.